This episode is brought to you by 180 Markets, where it is our goal to bring every individual, fund manager, family office, or any qualified investor access to Australian Stock Exchange capital raises. If you are ever interested in how to access ASX capital raises in a super simple way, 180 Markets is for you. The sign-up process is easy. You just upload your ID, proof of your investor status, and your current brokerage account information. The settlement of shares goes right into your existing account, and you can access our very next capital raise. If you're interested in free, easy access to thousands of ASX capital raises, including placements, IPOs, reverse takeovers, and more, check out 180markets.com.
Good evening, everyone, and welcome to the latest 180 Markets Zoom interview. And tonight we're particularly excited to have someone who's been a star on the football field and really reached the pinnacle of the career in the sporting arena as an AFL footballer and premiership player and Carlton captain. And unfortunately tonight, though, we don't have Greg in the room together with Sean and Chris. Greg got the AstraZeneca vaccine so he wouldn't get sick, and he got sick. And he's quite well advanced on the mend, but Sean is concerned that Chris might be required to play for Carlton this weekend. So we thought we would quarantine Greg. So Greg will be remotely dialing in. So before I hand it over to Greg and Sean to kick off with our special guest tonight, Chris Judd, just a quick disclaimer. We're going to be, like all nights, talking about a lot of different things around people's tactics in investing and a lot of different companies that might get mentioned and so on. And just a disclaimer that we're in no way giving any sort of advice. We might be giving some perspective, some history, some ideas of things that have worked for us in the past, but this is purely just a sharing of ideas and concepts. We will as well tonight do a bit of a Q&A at the end, so we'll leave a bit of time for people to ask questions. If you do want to ask questions, you can just post in the chat and we'll look out for that. And then at the end of the interview, we can pick out a few of the most specialist questions, and we'll put that to Chris as well. So without any further introduction, I'll hand it over to Greg to do an introduction.
Thanks, Simon. Friends, competition. The actual Latin word for competition means to strive, to get the best out of yourself. And a lot of times getting the best out of yourself is working with others. And we have with us today a true competitor, both, as everyone knows, on the football field, but as well in the investment arena. And with us, Chris is going to talk all about his career, also investing, and how some of those skills that you can use from the football field apply to every other facet of your life. And with that introduction, I'm going to first turn it over to Sean, and then we'll just get into the investment tactics.
Thanks, Greg. And your voice is sounding a little bit better than this morning, but glad to see you improving. Chris, a big thank you for coming out here tonight. It's a big honour to have you in the 180 Markets offices. For those of you that don't know me, I'm a mad Carlton fan, growing up watching Chris on the football field, and it's just a great honour to have you here. And it's I guess after watching your football and after you retired, you in the stock market, and I know just from what I've seen, you're a genius on the stock market as well as on the football field. So it's a true honour to have you here.
Thanks very much. I'm very impressed with the office space, Sean. It makes me feel like Chris Judd Invest needs to step up its game.
Absolutely. Hey, Chris, rather than to maybe start from the beginning, I maybe take a detour and start out with a mutual friend of ours, Barry Karp. I know that you have a lot of respect for him and interviewed him last year. And I also had the pleasure of working with Barry. And as you know, he's incredibly meticulous. You go into his office, it's incredible what's on his walls. He has a number of musts for any investment, that is things that must stack up. And from your point of view, my first question is, whether it's an investment or a trade, do you have any certain keys that you absolutely must have on board to, to fire away?
Yeah, look, not hard and fast rules. So Barry is a legend, Barry Karp, and I was wrapped to be able to sit down with him last year and have a really good chat. And I know how much value he places on things like return on invested capital and free cash flow, and he's really diligent about that. I have different things for different investments in terms of what I'm looking for. So sometimes I'll invest in something because it's on a cheap earnings multiple. There'll be other times I invest in something because it's got really strong network effects. Most of the time, the things I'm investing in are linked with a top-down thematic. So a macro thematic, think sort of electrification of vehicles in the world and how that changes demand for things like cobalt and nickel and copper, or the baseload power and uranium needed to supply those EVs. And so mostly it's around a top-down thematic, and then companies that are in that thematic that you can see a reason why they'll re-rate over the next 6 to 12 months, depending on what sort of news flow they've got coming up. But I really try and steer clear of hard and fast rules. I think as an individual investor, one of the advantages you have over institutions is that you don't have a mandate and you can be more flexible, remembering that it is a zero-sum game where every time you're buying a stock, you're invariably buying it off someone, and you need to be confident you've got some sort of an edge over them. So I really try and stay flexible, not label myself as a growth or a value investor, but really as an investor that's looking at all sorts of opportunities and hopefully able to profit in different market conditions.
Yeah, absolutely. And I think said another way, it's play to your strengths, which is as an individual, the disadvantage is we may not have as much information as a mega fund manager who's having 50 meetings a day, but the advantage you have is that flexibility, if you will.
I think play to your strengths, but you also got to play to what the market's giving you. I mean, it's a bit like you're a cricketer. You might have a lovely cover drive. If the bowler's bowling short pitch balls at you all game, it doesn't matter how good your cover drive is because you need to be playing back foot shots. And I think that's, really relevant in today's market where some of the macro factors, particularly that are central bank driven, have such an outsized effect on valuations and what opportunities are attractive. So yeah, I think it's both. I think it's understanding what your edge is, but also understanding what opportunities the market's giving you.
So Chris, just on that, often I find fundamentals get in the way of shorter term trading. Do you ever get do you ever over-analyze stocks and find there's just, you're just looking at it too much and falling in love too much with certain stocks where often technicals dictate shorter term movement?
Yeah, probably. Technicals and really flow of money in the short term is what really moves the price.
Yeah.
So yeah, I think that can be the case.
Has there been a lot of cases where you've done your fundamental analysis and it's just not right for the current environment?
Yeah, well, I think so much depends on what the US 10-year is doing, and we've seen that.
Yeah.
Attractively growth companies were valued when that 10-year was dropping and getting closer and closer to zero, and as that started to rise in terms of yield, we've seen some of these value-based companies start to look more attractive, and it feels like we're in a bit of a rotation there. So I think so much of what we're doing today is driven by central banks and bond yields in terms of what assets are most attractive at any given point in time.
Yeah, no, absolutely. And, speaking of, what the market gives you, one thing I've noticed literally every single great investor does is massively change the amount of invested capital at any time in their portfolio. It kind of goes against a lot of theory, but everybody from a day trader out to Warren Buffett, will substantially change the amount of money that they have riding. And it's based upon what they see in the market at a time, because you just cannot force trades. In fact, that's the fastest way to probably lose money.
Yeah, I think George Soros is really famous for that. He has an investment thesis and he gets set in a particular asset class or a position. And then as that thesis starts to playing out, rather than start to sell off, he loads right up and tries to have a massive win. And obviously Druckenmiller's his most famous disciple, who a lot of investors really look up to. And if I think back to my best wins, not for a second putting myself in the Druckenmiller camp, but they've generally been how to play out. It's been by averaging up as you get comfortable with how the company's performing, comfortable with what management are doing. And it's generally been averaging up. And if I think of my worst outcomes, it's generally been when I average down thinking that the company's going to mean revert or turn things around. So I try and keep that in the back of my mind. Again, not as a hard and fast rule, but a general reminder that average up into companies that I've gained trust in has usually been a better outcome for me.
Yeah, and absolutely. And I think that one of the lessons, Chris, is that doing the work. In other words, knowing what is it for you that tends to work, whether it's averaging up or some people can do it, averaging down, noticing those patterns and really being kind of ruthless with yourself from that point of view.
Yeah, I think so. And it's I was talking with Sean off air before, but it really just does depend what the market's giving. From May to probably November last year, it just felt like capital raising was just such a gold mine, and there were so many coming through, and so many of them were working. It just made sense to almost try and get an allocation and do the work on the fly, remembering you can always sell down a few days later when they come on board. I'm probably being a little bit more selective now, and probably feel now that I really only want to be buying something if I'd be comfortable buying more once it dropped 30%. And I've bought a couple of positions recently, and they dropped, one of them dropped about 15 to 20%. And the fact that I really wanted to sell it was sort of a clear indicator, not necessarily that the position was wrong, but it was wrong for me, with my current portfolio strategy. So I think that's more the environment we're in now.
Yeah, no, absolutely. And, one of the big, we also, as you alluded to before, are pretty thematic, Sean and I. And one of our big themes is ESG. We think that, within that space in the subset, you're going to see a run at some point within fertilizers, some point within hydrogen companies again. Those are the events that those are the themes that we're looking for. Are there any certain thematics, you alluded to before, like the electric vehicles, that you're still very keen on despite interest rates moving higher?
Yeah, look, you've touched on a couple of really big ones. So, the EV thematic, so copper, nickel, and cobalt are the main sort of commodities I'm really interested in there. Uranium and that role it can play in baseload power whilst we're scaling up renewables, I think's an interesting place to look at. Hydrogen one's interesting. I'm probably more interested in platinum for the hydrogen play and the role platinum plays in electrolysis. I probably don't see the scarcity with platinum with hydrogen, just given how much water there is on Earth. But platinum and hard to play in equities, albeit, but I probably think that's an interesting way to play that. Aging demographics in the Western world, I think, is a really interesting thematic. The main thing that I find fascinating is just the amount of debt in the system currently, and obviously the currency debasement that's going on around that. And then sort of automation, AI, robotics, and that movement isn't the easiest thing to play on the ASX, but that is an overarching investment thematic. I think is really interesting as well. Broader green sort of movement outside of just the underlying commodities that are going to be needed to build that sort of green economy. I think the green movement more broadly, there's going to be a huge amount of wealth created there. And, a lot of those commodities I feel are going to mean revert after a few years, but, the runway for some of those green companies is probably a bit longer than the underlying commodities needed to green the economy.
So, Chris, saying all that, like, you're obviously doing a lot of research, a lot of reading. Do you spend a certain amount of time each day just doing research and reading, and where do you get your information from?
Yeah, it's mostly overseas newsletters.
Yeah.
So it's macroeconomic newsletters. So, like Luke Groman, who's got Forest from the Trees newsletter, is one of my favourites. Kirill Sokolov, he's got a news service, comes out Fridays and Mondays. Is brilliant. Real Vision, which you may or may not have come across, is produces some great content. I mean, Fred Hickey, the list goes on. So I mean, that's my job.
Yeah.
Is to sit and read or watch different content. And I don't know. I spend sort of 4 to 6 hours a day doing that.
And are you watching the screens pretty closely each day?
Well, not really. Not like a trader.
Yeah.
No. So
Okay.
it's really the main priority is that overall macro framework. Then the next priority is really company specific insights. So whether that's speaking to management or having a look at individual stock ideas. And then the last bit is sort of that execution piece.
Is one of your rules for getting into an investment speaking to management before?
No, it's not, but it just depends what size investment.
Yeah.
So, I mean, I wouldn't invest in something that was material to me without speaking to management, but there's lots of positions I have that aren't material as yet, and they may turn into one if things start to change. But to have a proper swing at a business, I'd need to get comfortable with management.
Yeah. Okay.
And also, Chris, as far as expressing those views, will you, whether it's just buy stocks directly or will you invest in funds or SPVs as well?
But just buy stocks directly. Yeah.
Australian.
Well, I mean, I'll sometimes invest in something that's pre-IPO and it'll end up listing in Canada or the US.
Yeah. If you get lucky and it does list.
I know. I've got a couple waiting to SPAC so at the minute, so I just need that SPAC market to hold together for a couple more months. But and I do some commodity CFD trading, which is pretty wild, and a little bit of Forex and a little bit of crypto. So there's there's a portfolio approach, if you like, and it's quite broad.
Right, that's a wide swath there. Maybe turning a hard left for a second. Everybody talks about buying, which is important, obviously, but selling is probably one of the most underrated skills out there. And I know, certainly for Sean and I, we're big sellers into volume or having the event play out. But that's really the thing that we're looking for, is that 3 to 6 month time period and the event to play out with a big volume push. How do you look at selling, or are there any, clues from your point of view?
I just completely agree. Firstly, I mean, I think property is about buying. You buy a property well, assuming you don't need the money for somewhere else in your life, you don't really need to sell it. It's just such a good, safe investment often. But I think equities, particularly at the small and micro cap, I think it's all about the selling. I think that's the skill and that's the challenge. I don't have hard and fast rules. I think sometimes individual investors can hang on to sort of one sentence sayings and can get themselves into trouble with that. They'll say you've got to let your winners run. And that's a really true statement if you've got Amazon, or if you've got some stock that's not going to mean revert with a huge addressable market. But if you're in a small single commodity play, commodities by their nature mean revert. So you want to be selling that at some time, and you want to have a plan for when you're going to sell it. You don't always have to sell everything all at once either. And I think that's something you can learn. Sometimes you're selling something just because you want to clear up the headspace, as opposed to because you think it's the right thing to do. So, sometimes scaling your selling is a useful thing to do and can take the pressure off that binary feeling of being completely right or completely wrong.
Absolutely. It's amazing how selling even 10% of a position can completely change your mindset, don't you think?
You can, yeah, and it can free up some headspace, and that's part of the game as well. And then not beating yourself up, because investing is about mistakes. It resembles football in that sense. Even the smartest investors in the world are constantly making mistakes. No one's getting out right at the top. No one's perfect. So that ability to not beat yourself up if something doesn't play out as well as it could have is pretty important as well.
Yeah, no, absolutely. And we all have stories about shares that we sold that continue to run like crazy. But a lot of times what we forget is the shares that we sold and then they actually drop a year later.
Yeah, well, also what you did with that money. You sell a share and it continues to run, but you've invested that elsewhere, and that may or may not have outperformed the share that you sold since. So I think that's an important thing to remember as well.
So let's do a little bit of a turn, and I guess a lot of people would be interested in how you started up on the stock market and what got you interested in it. I know playing for Perth football team, they must. I mean, there's a lot of the stock market is there, and Yeah, how did?
Yeah, so I missed all that. I was there for just about the biggest resources bull run ever.
Yeah.
And I didn't have an account with a single Perth stockbroker. When I was over in
So,
WA, I was investing with Melbourne-based brokers.
Yeah.
Buying bloody ANZ and BHP. You know, it's stuff that I just don't know how to make money on.
so, but did you get involved with the market before then? Like as
yeah, so from 18, I started investing my own capital, but
Yeah.
I was buying top 50 blue chip stocks because that's what people get told you've got to do.
Yeah.
And then I bumbled along, didn't really know what I was doing. And when I was 28, I met the chairman of a Perth broking business,
Yep.
funnily enough, well, even though I was living in Melbourne at this stage. And he really taught me how to invest and how to invest in the micro cap area of the market. And that really was a bit, sort of a major inflection point for me. And from then, I would describe it as learn how to invest, learn how to make some money, and learn how to sell. And it's just been a gradual sort of learning process since then. Post footy, I had about 18 months in a venture capital fund working as an analyst, which gave me a look at a different type of asset
in
class.
the property space.
Well, they did, but I was working more in their VC space,
Okay.
so I was assessing their VC deals. It was in the impact space. I mean, you know the guys, and VC investing isn't for me. You know, it's binary. I think the valuation at the time, I always thought the valuations were overpriced, particularly considering it was illiquid. And we've got a small addressable market in Australia. It maybe makes more sense when you're in America and you've got 300 million people to sell to. You know, so it's a hard one. Anyway, it wasn't for me. So listed equities were a natural fit, and yeah, I love it.
Absolutely. Hey, Chris, you know, you just mentioned VC just wasn't for you. And I think it leads to a really great point, which is you strike me as somebody that really tries to know yourself, because the market is as much about psychology as it is about, you know, getting out the Excel sheet. Is that something you actively cultivate as well, as like awareness of what your thought processes are going through?
Yeah, completely. I mean, I think the market's a good chunk of history, a good chunk of psychology, and a little bit of math. I think that's really what it's about. And I'm suited to VC. You know, the type of returns I'm looking to get are really VC type returns, but I want to get them in micro cap stocks where I can sell them if the returns don't look like they're going to come. So I'm not fussed if I have a win rate that's well below 50%, but I want to have some wins that are really big, and ideally sort of, you know, 5x plus. So that's the style I try and invest. It obviously clearly doesn't always go to plan. But it's sort of stylistically, it's a little bit the same as what VC investors are trying to do, but the difference is they're in for the ride, whether it looks like that 5x plus return is coming or not. As a listed equity guy, once it becomes clear it's not going to happen, you've got the opportunity to sell and move on to the next adventure.
I think it's a great point that you mentioned, and it's something that we have spoken to our investors about on these Zoom calls. Investing to your own personality, your own psychology. There's no point doing something that keeps you up at night if you can't handle the stress. And there's a lot of anxiety that comes with investing in the space that we invest in. And if it doesn't work for you, it's just not worth it. So, I mean, we like the psychology behind the market it's actually amazing. Like the amount of the risk reward that we're seeing every day, it's just not suited to so many people, and it's all about finding what works for you.
So why stock tips often aren't that useful, because you can get the stock tip from someone, but you can't get their conviction. And it's the holding, you know, is where you make the good money, isn't it? You know, people can trade and make lots of small returns, but ultimately the big return, it's that holding is what you get paid for. And it's very hard. You just can't borrow someone's conviction. You can get the initial stock tip, but that's such a small part of that whole process.
So for me, as someone who's thinking maximum 6 to 9 months hold, I've often struggled with getting tips because those tips are more fundamental. And as I said before, the market can really get in the way of that. So you've really got to pick on the trading, investing style that works for you.
Yeah, and people mix up the time frame is such an important part of it, which you've touched on, which people might say, I like a stock, but and they don't know, but it's very different. I like a stock for the next 3 months versus I like the stock for the next 10 years. They're such completely different investments and sort of investment styles. And I think that time horizon isn't always appreciated either.
Absolutely. In fact, there's nothing wrong with trading the same stock in different time periods where, you may have a portion that is for weeks or a couple of months, and then another portion that, you may be trading around it for years, so to speak.
That's right. And I've probably got over 40 positions, which is too many. I'd love fewer, but I don't want to sell any of those positions right now. And there's a few in there that I'm really treating as private businesses. Like, unless there's a huge liquidity event and something crazy happens, I'm really just not going to sell them. Now, that might be for reasons because you're in it with a group and it just sort of, that's just how you're investing, and you want to see something through to hopefully there's a capital event and the whole company gets sold. Or, there'll be other times where you just think it's a really big addressable market that's going to take a long time to play out. So there's a few in there that fit in that bracket, and then there's others in there where I'm happy to wake up, and if there's some liquidity there, I'll be selling. So it doesn't have to be all the same for your entire portfolio either.
Absolutely. Working back into the psychology for a second, I've always found it's very important to not get too high on your wins or too low on your losses. You're probably not as good as your best trades and not as bad as your worst trades. I'm just curious, did you notice that same phenomenon when you were playing football as well, where there's so many games that you just can drive yourself crazy with the highs and the lows?
Yeah, I think that's right. I mean, I think, I think there's a balancing act. I mean, I think it's nice to try and celebrate if you have a really big win, market and enjoy it, either with the people who you invested with or, with your family or whomever. Because you should enjoy the wins. Like, it's hard enough to get a win, whether that's on the football field or in the investment landscape. And you need to learn from both your wins and your mistakes. So it's no use making a mistake and just going, oh, well, it'll even out in the wash. Like, that's an opportunity to learn from, and that needs to happen. But you're right. There's, we would all know personalities, and you know that when they've had a big win, they go and they buy stupid they don't need, and start acting like they're God's gift. And that, that's often a signal they're going to have the market will teach them a lesson, because that's just what it does. And I've found that myself historically. If I have a good year or a good couple of years, it's not very long before the market gives me a whack across the head. So I'm pretty conscious of that as well.
Yes, the market will find your weakest point, no matter where it is.
It's hard to catch up. So, I mean, if something's been working for you from a period of time, you generally keep doing that until it stops working. So most people go 6 months too far on a strategy, or 3 months or 12 months too far before they decide, no, that's no longer working, I need to change. And it's just often how it plays out, where a couple of years of outperformance is often accompanied by a tougher year.
Absolutely. And I think that right now we don't know if we're at an inflection point in the market, but you alluded to it before. Interest rates have shot up about 50 basis points, which really in the whole scheme of things is not a lot. But boy, has it had a huge change in the valuation of growth companies. And it's just, the market is a beast, and it's always changing.
Yeah, I mean, none of us know the future, unfortunately. Otherwise, you'd be a lot wealthier. But it feels like we're at an inflection point around leadership in the market. And obviously, we've had such strong leadership from big tech companies in particular, the FANG stocks from overseas. And we've seen stocks with similar characteristics like Afterpay just completely dominate on the ASX. And, it feels like there is a shift either to more value-based companies or companies with real assets like commodities that are going to potentially benefit from the inflation that we're seeing. Whether or not that's transitory, as the Fed will lead people to believe, or whether or not that's something longer term, we'll wait and see. But it certainly feels like there is a bit of a rotation there.
Yeah, and that's why one of the reasons why Sean and I right now, we are trying to be extremely patient and more stock specific, and more price conscious where, with our entry prices is just from that point of view. And one of the hardest things is to sit on your hands and just watch every day. But it's, just it's such a critical skill. The ability to do nothing.
I think we've gone through the time, but we know there's going to be a few questions coming through. Just before we do that, Chris, I'm going to put you on the spot. You don't need to answer me. Have you got a stock tip for everyone out there?
No.
No? Good answer.
If I just said stock tips for every rate and then I started giving them. But no, I don't. I leave that to the fund managers I speak to every Tuesday.
Okay, good. So do you want to just give your show a little bit of a...
I will. So Chris Judd Invest, we interview fund managers. We've got a couple of shows, Talk Your Book, where they walk through their highest conviction investment idea, Master the Market, which is like a This Is Your Life of the fund manager, and then New Media 2.0, which is a joint venture with a media VC fund. And look, I won't give a stock tip, but I will say I'm really set for a weak USD. So I think the US dollar is going to weaken, which I think is really bullish for commodities. I think what's maybe non-consensus is that whenever we've seen inflation in recent history, the reaction from the Federal Reserve or central banks around the world has been to raise interest rates. It's not since the 1940s where we've had yield curve control in the States. We've got a version of that in Australia here, but the States is what really matters. And essentially the idea that we could get inflation and looser monetary policy as the Federal Reserve keeps interest rates capped, I think is a wildly good environment for commodities. And that's how I'm positioned. And I think investors that are just saying this will be the same type of response, an economy that we got post GFC, where we didn't really get inflation or the sort of growth required. I think it'll be different this time for a number of reasons. I think it's almost a national security risk in terms of the Cold War with China and the US, if the US doesn't have continued strong growth. And I just think the debt pile in the US at 130% of GDP, they need inflation to reduce that debt in real terms. So not a stock tip, but sort of the main basis for my position. So hopefully someone might find some utility in that.
Sure they will. So I think Greg, was that, I think we'll...
Yeah, so we've got a few questions that have come in. Nice. Yeah. So thanks for that. It's been fascinating chat, Chris. In fact, I think Chris and I have sort of chilled out through that chat. We've both migrated to our hoodies now, which is good. So the first, I'm with you on that. The first question was, have you got a stock tip for us? But I think we've done that out now. So another question that came through is, what do you sort of see as some of the skills that you've been able to port across and you really lean on from your playing days into your, most recent sort of investing days? What are the things that you find that really, fuel you in this new career?
I think just an ability to regularly analyse past actions and hopefully improve on them is what you try and do as a professional athlete, and very much what you try and do as an investor as well. I've got a pretty high tolerance to risk, which is both useful if you're playing a contact sport or investing in micro-cap equities. I'm often quite enjoy high-pressure environments. Not in all instances, but I find I often think clearer in higher pressure environments, and sometimes maybe low levels of pressure constantly is not what I'm as suited to. So I found the sort of March meltdown last year quite stressful, but I actually really enjoyed it as well. I was able to act and think pretty clearly throughout that meltdown month, which was a challenging period to be an investor. So I think there's some of the traits that helped me in the past. Who knows how to work out.
Is there a drive to win that sort of sits underneath all that as well? Do you sort of see it as a bit of a game?
Well, it's a complete game. So, I like that with investing. You've got a scoreboard, and I track that, meticulously, and less about the money, but more about the winning. And I consciously try and be different to what others in the industry do. So I make sure I measure my year April to April as opposed to calendar year or financial year, because I just don't want to get that pressure to lock in a win the same time everyone else is trying to lock in a win. So there's little nuances I try and do. But yeah, I mean, I'm not as obsessive about winning in investing as I was about football. You know, I'm really not trying to take over the world, but I'd be lying if I said that scoreboard element wasn't an important and enjoyable part of it.
Excellent. So you mentioned before, Chris, your podcast, Talk Your Book. And so someone was just asking, you know, you've interviewed some really interesting people. What are some of are there any real key takeaways or some big surprises that you've learned from, you know, doing those interviews?
No, I think the big takeaway is that there is no right or wrong way to invest. It's the point Sean made earlier. There's a right or wrong way to invest depending on what your personality and skill set is. And often, you know, the people I speak to, they're brilliant in one area, but they're just not interested in different areas of investing because they've found their edge and they've found their niche, and they're just completely brilliant at that, and they over-index their time based on that certain niche area of the market within which they operate. But yeah, I think, you know, the other thing, I think that the smarter the investor, the more willing they are to talk about their mistakes. Something else I've generally found.
That's a good segue to the next question, actually. So someone's asking, your sort of biggest investment mistake, or you don't have to be sort of specific about which one it was, but more so the learning from it. So is there sort of a time where you've kind of taken yourself to the investment tribunal and lost?
Yeah, well, averaging down, I sort of touched on it. There's been, I'd say too, I averaged down on companies that I didn't have huge conviction on, but I almost just wanted them to work out. And I think investing post big wins hasn't been a historically successful one for me. So after, you know, good years, or if I've exited a couple of positions and it's been materially significant for me, I've often fallen into that trap of thinking I was smarter than I was, or maybe, you know, not being as strict on the diligence as I should going forward in the near term after that.
So I'll just butt in there. I actually can't remember where it was. Greg and I were talking about trading styles and our biggest mistakes. And one of my biggest mistakes is not an actual mistake, but it's when I get the gambler's mentality into my head. And there are two different times. One is after big wins, where you try and go even bigger, and you just try and gamble your way up. You're changing your, I guess, your investing or trading rules, and the others are completely opposite. When you lose money, you try and make it back. Just to use the market to try and make it back, I've found those are the times that I've had my biggest losses, the biggest mistakes.
Yeah, I agree. And also, like, trying to get the market to fit in with your own personal circumstances doesn't work out. I mean, sometimes you just have to do it. But I had a situation last year where I just had too many positions, and I just one day I said, right, I'm cleaning up, you know, the bottom 6 positions, and they weren't big positions at all, but you know, one of them 17 bagged within about 8. Like it was, and another one 10 bagged. Like it was just, and they weren't big positions to start off with. So, but once they 17 bagged, they were sizable. It was just, and the only real reason I did it was just I just wanted that feeling of having fewer things to look at on the watch list. That was the real driver. So, yeah, I mean that's another one.
Yeah, we've got Jake in the office who was holding EAP.
Yeah.
And he sold some recently. And
Day-to-day. Good luck, Jake.
the whole day I was telling him, just don't worry about it. You made money. You got to be happy. I know you could have made a lot more, probably more than what you did in the whole year, but it's fine.
And all you see when you go on the Twitter then, or when you like anywhere you go, all you see is those letters. I had that with was it Bard one?
BD1.
Yeah. I never bought that, and I sort of thought it looked interesting, and it just was and
you get used to this environment.
Yeah.
Jake's just with me here. He's just started crying again, Sean. So,
Everyone wants to see it.
so probably last question, Chris, because we're short on time, and it kind of, I think, wraps up a whole bunch of other questions here in one. And we've got sort of a broad investor base at 180, and some are expert and have been doing this a long time, but we do have a lot of newbies. And I guess, you know, a lot of people admired you on the footy field and had your number on their back. And now, you know, people sort of moving into the investment world. So if people are thinking about doing more of what you do now, but they're coming very much from a beginner's angle, you know, what would your bits of advice be without giving advice?
Yeah, well, there's a good story in, I think it's James Clear's book, Atomic Habits. So there was a study done at a university where a photography teacher split the class into two groups. The first group, he said, right, I want you to take minimal photos this year, but I just want you to go out and take the very best photo you possibly can. I don't want you just shooting at anything. Really be scarce with the photos you take. And at the end of the year, come back and bring me a masterpiece. And the other group, he said, look, just go out and take photos. Take as many photos as you can. Don't worry about it. Take, you know, the more the merrier. And at the end of the year, the group that had all the best photos was the one that had just been taking a bucket load of photos. And I think that's how things work. You know, people look at great musicians, and because they didn't see them when they were a 14-year-old and they were a crap guitar player, they assume they were just born on the earth as a musician. But the reality is, when anybody starts something, they're no good at it. So the best way to do it is to get going, but don't risk a huge amount of capital. You know, you may start your investing as an education, and the money you're actually investing with it may be with a fund, or it may be with ETFs, and then you have a portion of your portfolio which is around education, and you learn that by actually investing. But yeah, I don't think you learn it by just investing in fake portfolios. I think that's, you know, that those psychological lessons you learn can only be learned with real money. And don't assume that, you know, sure, get some things from Warren Buffett and the great investors around the world, but if you have to develop your own style eventually, otherwise it doesn't make sense why you're not investing in Berkshire Hathaway if you're just going to be repeating everything that Warren Buffett says all the time. So if that's not your personality and that's not your skill set, then maybe you are better off investing in funds, and that's great. There's nothing wrong with that.
I think what you're hinting at is you've got to learn from your mistakes.
Yeah, I'm sort of saying a lot of things in a roundabout way, but I think you need to learn from your mistakes, but you need to develop your own style. Otherwise, if you don't have your own style, you should be investing in funds and other people that do. Yeah.
Fantastic. Thanks, Chris. Guys, we're pretty much out of time now. And Chris, thank you so much for joining us tonight. It's been an absolute honor, and it's been hugely insightful. So we thank you very much for coming and joining us in our office today. Thank you, everyone, so much for joining us, and I'm looking forward to seeing you at our next interview. Thanks, everyone. Have a good night.
Thanks, guys.
This episode is brought to you by 180 Markets, where it is our goal to bring every individual, fund manager, family office, or any qualified investor access to Australian Stock Exchange capital raises. If you were ever interested in how to access ASX capital raises in a super simple way, 180 Markets is for you. The sign-up process is easy. You just upload your ID, proof of your investor status, and your current brokerage account information. The settlement of shares goes right into your existing account, and you can access our very next capital raise. If you're interested in free, easy access to thousands of ASX capital raises, including placements, IPOs, reverse takeovers, and more, check out 180markets.com.au.